Do you want to have the confidence to truly rock retirement? Well, I'm going to show you how on the Retirement Answer Man Show. Well, welcome to the show. My name is Roger Whitney. I am your host. Excited that you're here as we continue this month-long series on inflation and retirement. Inflation's a hot topic right now. Today, we're going to talk about how inflation impacts your retirement. And then next week, we're going to explore high-level strategic things we can do to manage the inflation risk. And then in the last week, we'll explore inflation, answer a lot of your questions, and talk about some tactical things. So what is the issue? How do we think about it? How will it impact us? What's the overall strategy to deal with it? And then what are some tactical considerations? So that's what we're going to continue to do this week. Now, before we get started, I have two quick things I just want to share with you. One is a book that just came out called The Good Entrepreneur by Nick Kennedy. Now, I'm mentioning the book, one, because it's a good book. Two, Nick is my business and personal coach. I don't know what he called it. He led Townsend Leadership Program last year that I went through, and I'm working with him again this year. And he's just a really good guy from a business standpoint. He's actually done it, but also on the personal end of it, he's done a lot of work and he melds those two things together well. So if you know an entrepreneur in your life, The Good Entrepreneur is a good book to check out. I love Nick. Second, I had an email from Mark that sort of coincided with an active conversation we've been having in the Rock Retirement Club on overcoming frugality. This idea of if you are in a position because of being frugal and saving and investing and managing your cash flow, that when you are in retirement, sometimes it's difficult to relax a little bit and actually use some of the resources that you created. It's not a muscle that we necessarily have built up enough. And so Mark emailed me saying that he was afflicted with this imbalance of always maybe a little bit too frugal, because he says it's clear that it's feasible for him to do a little bit more. And he shared some things that he was going to do to try to overcome this frugality. He said, number one, he wants to fly better, business class or even first class. Two, he wants to pay a few bucks for a Kindle book. Always a good idea to buy a book. Three, he says he's going to check heated seats when purchasing his new car. They are wonderful. Four, he's going to order extra avocado or bacon on the sandwich, and it's okay. No more cheap pens, he says. God bless you. Get a fountain pen. They're great. Next one is skip the powdery crumbs at the bottom of the cereal box and chip bags. He's not going to lick every last drop out of it. And the last one he said was, you don't ever have to eat Taco Bell again. So good for you, Mark. I appreciate you sharing that. With that, let's move on to talking about how inflation impacts your retirement. So last week, we looked at inflation from a historical context and what inflation is and how it's measured. And we know it's going to impact us over time. It's been impacting you your entire life, right? That candy bar that cost a quarter now costs, well, I don't know what a candy bar costs nowadays. The gas that you used to pay 50 cents a gallon for now is what, $2-3 a gallon? We know inflation impacts us. It happens all the time. So that's just going to continue. So when we talk about how it impacts you, and maybe this comment should go in the strategic standpoint, but I feel moved to talk about it here, is we got to make sure we don't overthink this. We're building these long-term retirement models to see what's feasible and how do we make it resilient. And we have to have an inflation assumption in there for various things, and we'll talk about those things in a moment. And during times of elevated inflation, right now, as an example, it's very easy to start tweaking these models all over the place just to see how things play out. What happens if I put my inflation assumption at 5% for the rest of my life or 10% for the rest of my life? And you tweak it in your software and it spits out the numbers. But if you tweak that, we forget that a lot of other things move around too. And you're not really getting any more accuracy by doing all of these adjustments, especially when we're in a moment of what we call tilt in decision making, where inflation is sort of front and center and we're worried about it. So it's very easy to tilt and overreact to it in terms of our planning. So be careful with your assumptions. The important thing about assumptions in retirement planning is you want to have at least some methodology for how you choose those assumptions. That's much more important than what methodology it is, within reason, of course. Are you going to use the historical data as it is? Just get the longest string of historical data and use that? Are you going to use someone else's well thought out assumptions on whether this applies to market returns, inflation returns, etc.? There are plenty of very intelligent, diligent individuals that come up with assumptions, forward-looking assumptions based on a methodology that they've slowly honed over time regarding market returns, inflation returns, sub-asset class forecasted returns. If you're going to use one of those, which is totally fine, just find one where there's at least some well thought out methodology that resonates with you. And then once you've done that, don't switch methodologies or styles. Don't choose one that you like and then a year later fall out of love with that one and find another methodology that looks at forecasted inflation or returns a different way and then switch everything to that one. And then the year after that, switch to another one. If you do that, you really have no process at all. And that's not going to help you when you're rerunning these models over and over and over again. None of your assumptions are going to be right. Whether you use historical data, whether you use forecasted data based on your own methodology or some investment firm's methodology, none of them are going to be right. This is one reason why you want to be agile and you want to iterate, but it's really important that you have one that you are comfortable with, that you use consistently. Because as you iterate and life unfolds, you'll be able to actually have meaningful data to make little adjustments along the way. But if you keep flipping methodologies of how you choose your assumptions, well, then you're just sort of in the wind. You're not going to have this cumulative string of data to help identify trends and make little decisions. And we looked at returns over the decades. In the last 20 years, the average inflation rate has been 2.56%. That has been below the long-term inflation rate of about 2.88%. Over the last 10 years, inflation has been 1.73% a year on average. So well below what the long term has been, over 1% a year below. And that's important because I've been planning during that time frame. And when I look back at clients, and we use historical data, when I look back at clients in our iteration on their spending, we don't actually increase spending by inflation every single year. Now, we have it in our models because we're forecasting long term, but we don't automatically institute a inflation adjustment at the beginning of each year, as an example. So we generally, clients I have found, individuals that are retired, maintain their spending pretty steady because they're used to getting the paycheck that's set up, just like in work. And it's amazing. Internally, they just moderate how life goes. And then every now and then we make an adjustment. So that's number one. So we've actually have been spending under our long-term financial models because we're not doing that. We're not doing the automatic increase in the money that we're sending out and paycheck-wise. Secondly, and this is the thing that gets lost in you building these long-term models, is every single client is essentially each year we have the model that we've done, but we end up redoing the whole thing anyway because they're changing their minds and they're deciding to do other things. Things come into their life, things go out of their life priority-wise, and you're likely going to be the same. So we never actually yield, hey, this beautiful 40-year model. And I think both of these things are really important because it makes getting the assumptions dialed into what is the right one becomes much less important because it's all going to change. That's one reason why we use historical data. So just some thoughts on that. That may have been, I may say this again next week as we go through the strategic part of it, but it's important to understand. Okay. How does inflation impact your retirement? Well, the number one area is spending, right? And we talked a little bit about this last week. If you spend $9,000 a month today, in 15 years at 3% inflation, you will have a reduction in standard of living of about 36%. That $9,000 that you get in your pocket each month today will only be able to buy about $5,700 worth of goods in 15 years. That is inflation because the cost of things increase over time. And the big worry and the big risk of inflation long-term is, well, what happens if we have higher than 3% inflation? Well, that $9,000 a month that you get to spend today, if we have 7% inflation for the next 15 years, you will have a 64% decrease in your standard of living for that $9,000. That $9,000 15 years from now, if we have 7% inflation, is only going to be able to buy about $3,200 worth of goods. That's the big risk. Because if you want to spend $9,000 a year, and that's what you have in your budget going forward to live the life of you, inflation will slowly eat that away. So that's what we're dealing with here. So spending is the big one. Now, there's different kinds of spending, right? There's normal spending, which is captured by the CPI. In planning, we tend to use a different inflation rate for healthcare because there's a lot less optionality in healthcare, right? Especially when you're on Medicare, you're paying Medicare. And if you have an event where you need healthcare, you're likely going to do it. So this is much more of a critical thing to have. Well, between 1935, is that 35? And 2021. Oh, yeah, it is. Okay. Medicare experienced an average inflation rate of about 4.69%. That's a long time frame. That's from the Bureau of Labor Statistics. Years with the largest increases were 1975, a 12% increase in Medicare, not Medicare, but medical care coverage. 1982, 11.6%. 1980, 10.95%. Since 1985, this is going through 2015, medical care inflation was about 3 times what just the normal CPI inflation rate was. If you think about that, it makes a little sense because we've had the proliferation of medications and procedures, a lot of them elective procedures that are now required procedures. The healthcare industry has been in its renaissance of trying to do more stuff for us as technology has increased. So you can see the inflation on healthcare in general is going to be higher than normal inflation. Now, if we look at Medicare, we just had the largest one-year increase in the program's history. Part B went from $148.50 a month to $170.10 a month. So that's the largest increase that we've had, about 14.5% in the program's history. So when you're estimating healthcare inflation, my suggestion would be to use about a 3% premium to the base inflation rate that you use on your normal spending. Is that going to be right? No, it's not. Now, can you skew this? Yes, you can, depending on your consumption of healthcare. And I have definitely seen this in my lifetime doing this, is there is a big spectrum of healthcare use by individuals. Some people, they don't use it very much. Others use it a lot. In fact, I just came back from Florida and had a presentation on research on healthcare usage, and I'm digesting that, and I'll share it in some form. And based off of the research data, this is done by T. Rowe Price. And the nice thing about some of these large investment firms is they hire researchers that just do research on retirement and all sorts of things. And this gentleman did research on healthcare and healthcare cost planning. And in the presentation, with lots of caveats, the risk of a major healthcare shock from a monetary standpoint is a lot less than we think it is. Based on the data, you have to be in a very, very select group to have your healthcare expenses explode during your retirement. I'm digesting this data, but I thought that was interesting. But regardless, for your spending inflation rate, and I probably should have said this, go ahead and use a 3%. I think that's reasonable. And then use a premium for healthcare of about 3%. And I think that's a reasonable assumption to use. Now, when we think of long-term care, and we're not talking about the insurance, but actually just needing in-home care services or services in a facility, from 2004 to 2020, the cost for facility and in-home care services rose about 1.88% for facility to about 3.8% for in-home care. So fairly close to inflation or the healthcare insurance inflation rate that we're talking about 2 to 4% has been the increase in the cost of services, over the last 16 years or so. Now, in 2019 and 2020, things grew a little bit more rapidly. In-home care rose about 4.4%. Private nursing home costs from 19 to 20 went to about 3.5%. So we've seen some elevation in the last year or so. But the cost of care has pretty much tracked inflation, or inflation at a little bit of a premium for a period of time. When we think of long-term care and the cost of it, it's usually we think about the insurance premiums, where we've had these headlines on long-term care insurance where we've had 10, 20, 30, even 40% increases. And we see those when an insurance policy applies to the state insurance board, the board approves the increase and it becomes a headline. And I think our sponsor, Long-Term Care Insurance Partners, has some context for this. I know they've shared it in the club, and maybe we'll have them on to talk about it when we do that series again. When we talk about long-term care insurance and inflation, there's a little bit of difficulty in there. If you look at long-term care insurance, they don't increase it every year. So what ends up happening is a combination of how they underwrite it and whether they got those numbers correct, and the fact that they don't increase it sometimes for decades, and then they apply for an increase. So the increase happens all at once, which is a much bigger number than if it were just to happen a little bit at a time. So it's a little bit misleading, those headlines, but it's still real money when you have it happen. So that's the spending side of things. I think a reasonable estimate is 3% for general spending, do another 2-3% on top of that for healthcare. And I think you're going to have a decent model with those assumptions. Now, if you use some other methodology, just stick with it. Now, what about the income side of things? Well, on the income side of things, you're going to receive money that has some inflation adjustments. You're going to have what they call COLA adjustments, cost of living adjustments, COLA. And certain benefits that you get have an adjustment like that. The big one is going to be Social Security, right? It adjusts each year based on the CPI-W. If you recall, we talked about what that was last week. So from 1975, right around the time they instituted it, to 2022, the average COLA adjustment or increase in your Social Security payment each year has been 3.7%. Not bad. So when you start Social Security, it's going to go up each year based off of how they measure CPI-W. Now, since 2020, the cost of living adjustment for Social Security has increased on average 2.2% per year. We've had low inflation, so it's been lower. I think we've had a few years in the last 20 years where it was a 0% increase for inflation. Since 1990, it's been 3.2%. Since 1980, it's been 5.8%. So you see one of your biggest benefits, this Social Security benefit, is going to adjust for inflation, meaning the payments will get more and more as inflation adjusts, which is going to help offset your spending inflation and also help offset your Medicare inflation. This is a big benefit. And this is one reason with Social Security planning, I don't think it's good to think about it as where the cross-even point. I don't think it's so much a math problem as this is a lifetime annuity, guaranteed income stream that also adjusts with inflation. And that's how we should approach it. Pensions, some pensions have adjustments for inflation, especially if you're in the government and the municipal world. So we can count on that. So if you're going to look at the adjustment for Social Security, I use 2.4%. I use a little bit below what normal inflation is, just to be conservative, but I use it consistently. And obviously human capital, if you're working part-time, that will increase a little bit each year as wages rise. I think we're actually in a renaissance here, to be honest with you, for people that are retiring now that are either consulting or doing something in the professional realm, because there is such a demand for talent, especially in white collar work. I think there's a demand for talent anywhere if you can demonstrate it, that wages are increasing more than normal for those that can demonstrate and deliver. I just reread a book called So Good They Can't Ignore You, which is a book really written for college kids, written by Cal Newport. And it talks about building up career capital, which is your competence, not just in the craft, but in doing things when you say you're going to do them and following up and all that other stuff. And then so he walks through building up career capital by being so good they can't ignore you, and then figuring out how do you leverage that career capital to buy you more freedom. And it's really meant for college kids, but honestly, I think it's a great book for anybody in their 50s or 60s that is looking to transition from their career and they still want to be active and earn money, but just have more time freedom. Because if you're in your 50s or 60s, you have a lot of career capital built up, a lot of expertise, and a lot of just self-discipline that we forget about because it's so normal to us. So if you're looking to transition to something where you have more time freedom, I would suggest reading it, because I think there are a lot of really good concepts for you to help identify it and move forward. The last area I'm going to touch on in terms of how inflation impacts your retirement is really going to be tactical, because all of this stuff works out. When inflation rises, what happens? Well, if you're a company that produces something, the cost of the inputs to produce whatever it is you're putting, that could be employees, that could be steel, that could be machinery, etc. The cost of inputs increase, and consumers are a little bit tighter with their money because you're going to have to pass that cost of inputs on to the consumer. So you have this sort of transitionary period where just to produce what I'm producing is costing me more. Consumers are a little bit tight with their wallet because I'm raising prices to cover the cost of inputs, so their ability to buy my goods goes down, and that is a rough transition. We've seen this with stores that are increasing prices. Well, consumers don't react well to that. I don't want to pay that for that. So I'm going to not buy that, or I'm going to buy less of that. And so that in turn hurts companies whose profits and margins get squeezed, and it can be uncomfortable. Over time, an equilibrium is found, but in times of rising inflation, it puts stresses on the consumers and on companies. And that's important to understand. And we couple with that, one of the tools to fight inflation is to increase interest rates. By increasing interest rates, it's good for, say, you buying a CD, because you're going to get paid a little bit more in your money market. But on the company side, it hurts them because now their cost of goods, the employee that they're hiring or the steel that they're buying, goes up. And now if a company borrows money to fund their operations, the cost of borrowing that money goes up, which hurts them as well. Now, all of this evens out, but that transitionary period when we have rising inflation, then what will follow is rising interest rates, that can be difficult for companies and for consumers, which can dampen the price of companies because they become a little less profitable during this period until they reach equilibrium. And that's the struggle that you see going on economy-wise. And in the stock market is we have this rising inflation rates that may not be transitory. What does that mean for companies that use a lot of debt? Because if they use a lot of debt, that means they may have to pay higher interest rates, and it also may mean that they have to raise prices, which hurts their demand. That's the discussion that's going on in markets, in equity markets right now. And then companies that don't use a lot of debt usually benefit from this in the interim. Now, what about bonds? Bonds are a loan where you lend somebody the money and they pay you interest. Well, what does inflation do to that interest rate? Well, if inflation goes up, the value of the interest that they pay you doesn't have as much purchasing power. Well, that changes the dynamics, right? If you're getting $1 from interest for a bond that you own or a mutual fund that owns bonds, and all of a sudden that dollar doesn't buy as much, you're not necessarily as happy. And so it degrades the value of that dollar. And also, if we see rising interest rates, the bonds that are currently issued become less attractive relative to the new bonds that are being issued at the new interest rate. So the price of those bonds go down. And so there has to be an equilibrium found there, which causes bonds to be hurt twofold, right? The value goes down as they're issuing new bonds at higher interest rates. If you have a bond that you're getting $1 interest from, and you look over to your left and there's a new bond that will pay you $1.20, well, you don't like your bond near as much, so you might sell that bond to go buy that one, or the value of your bond will go down so a new buyer can get $1.20 because that's the new set rate of interest. This is the struggle of what we're all trying to figure out right now. And obviously, cash just erodes your purchasing power, right? Cash is really important to fight sequence of return risk, but it really takes on inflation risk. And that's what we'll talk about next week when we talk about strategery. So these are some ways that inflation can impact your retirement. And next week, we're going to talk about how do we get strategic about dealing with this inflation risk so you can rock retirement. Tanya Nichols is with us to answer questions, your questions. Tanya, how you doing?
Hi, Roger. Glad to be here.
How are things at Align Financial?
We're busy this week. Cooper is traveling on the beach in Cabo San Lucas. So we'll see how big of a mess I make while he's gone.
This is one of the funny things of when you build systems, because Tanya and I were talking about this before we came on, is when you build systems and you have teammates, and I'm sure a lot of you can relate to this. When a teammate leaves, you feel a little helpless. You can usually pick up the systems, but things that you used to know how to do just easily all of a sudden are like, wait a second, how do I do this? So that's what you're experiencing, right?
Oh, yes. Yeah. The same thing happens when you're at home and somebody leaves for a few days and you're like, well, now I have to take out the trash. Well, I don't like to take out the trash.
Where are the garbage bags?
Yes. Actually, there's a little bit of that going on this week, but I'm glad he's enjoying himself.
Yeah. And actually, this is good because it's a stress test of the system to make sure that one person isn't that critical. Things shouldn't fall apart, right?
Right.
Just like a spouse, if they communicate all the passwords and the accounts and everything else, if the bill payer can't do the bill paying, the other one should be able to figure it out with the systems. See, I can turn anything into a retirement lesson. So Tanya from Align Financial is here to help us answer questions. And our first question, Tanya, is a doozy. Frank has a question. Basically wants to know if he is in an okay spot to retire because they've been offered an early retirement package in spring of 2022, which is exciting. These buyout packages have really accelerated because of COVID and other things. And one of the upsides, I guess. And so I'm going to read some tidbits of his question. I can't read everything because he gives a lot of information, which we don't have time to go into, but I do want to help him have a framework for how to approach this. So Frank says, I recently took an early retirement package from my employer, and I am not sure I will remain completely retired, but that's the decision for spring of 22. The early buyout was unexpected, but I was burnt out from the grind, so I couldn't pass it up. We felt financially we were in an okay to good shape. Hope you agree. I am being paid through the end of March. And he gives a lot of background to us of we were trying to figure a few things out. How do we look overall? He wants to figure out, could I just not work ever again? Or do I have to go back into the grind to be okay? He talks about his wife who is working part-time, I think. Where is that at? And she's maxing out a 401k and she loves her job. And he gives a lot of the financial background in terms of, I think their overall investment portfolio is like $3.5 million, not including the house. So depending on your lifestyle, it sounds like you're probably in a decent spot, but it sounds like he's trying to get clarity on whether he could not work ever again or whether that's imprudent. How do you approach that?
My initial thought when I read through Frank's question was, well, do you want to work or not? More thinking about what do you want your life to look like? I think he's covered a lot of his bases. I mean, he's got cash available. He's got big expenses covered for his kids' college. So he's thought through a lot of those items. I might spend a little bit more time thinking about, what does not working look like? You were burnt out. Are you not burnt out now? Like, have you replaced that time with something else? I might spend a little bit more time in that area, because it looks like he really has done a lot of work to put himself in a solid position to be able to have choices. Whether he goes back to work in a year or never, I think it's going to be more about what it feels like to be fully retired or not.
That's a good point. The burnout question, I think I didn't really think of it from that angle, but I think that's a good point, because it's easy to say, I'm never going to work again when you're burnt out, because you're burnt out. And after taking a couple of weeks off in December, and I already shared with you, Tanya, privately, I looked back, I'm like, wow, I was really burnt out from everything we did last year, more than I thought. I didn't realize it when I was in the middle of it. People were saying things, but I'm like, no, I'm fine. I just got to keep working, until I took a step back. So it sounds like with Frank, this is going to be a chance for him to take a step back to see, was he really burnt out, and evaluate whether it was just burnout or, yeah, I'm ready to retire. Because I'll take myself now. I've put some systems in place that I'm building a habit from, so I don't get into that position again. And I actually feel really empowered and excited again. And maybe Frank would have that. So I think that's a really good observation, Tanya. My thought, Frank, was that, and you gave a lot of financial information, and I can't send you back a financial plan, I'm sorry. But I think the way to have confidence in whatever you decide is, I think the two things that you probably should focus on is, one, really diving in. What do you have this chance because of this buyout? What do I want my next stage of life to be? It's a whole new season. Really leaning into that, because let's face it, you got $3.5 million in investment assets. If you don't want to work and that's really what you want for life, you got the assets to do it. If you need to spend so much money that you don't have the assets to do it, that's just a value decision. But if you really didn't want to work and that was most important to you, you could do it. So what do you want? What do you want is a really difficult question. And you're coming out of probably decades where you never really had to answer that question, because you had it. You were just doing your career and working the system. Now you have to create a whole new system, and that's scary. So I think one is, who do you want to be when you grow up, is something you need to explore. The second thing I think is to have go through a process so you have the framework to create what if scenarios and to put your plan on a scale to make sure that it's feasible. Because that's the first stage of a really good retirement plan, is to have a plan that is feasible. And then you can figure out, how do I make it resilient? How do I do tax strategy to optimize it? I keep going back to those three pillars, because that's a good way to organize it, because otherwise you're just inundated with information. So I think you need to follow a process like that. We've talked about the process, obviously, in the club. We have the class that teaches the process, but it sounds like you got the resources within reason.
Yeah, I don't think it's a financial decision. I think it's more of what gives you energy.
And I think
what gets you excited.
And I think lacking a framework to see what's okay and what's not from a financial management standpoint, to put it on the scale and say, yes, this equals out. If you lack that perspective, it's hard to have confidence in it. And one of the things I've observed, Frank, and I know I'm guessing Tanya has with clients, just the fact that you're listening to this show and you've shared your resources sort of skews you to this anyway, to this constituency, is most people that listen to a show like this anyway, it's not the financial feasibility part. It's having the confidence to do it and trying to find a way of giving themselves permission to do it. Maybe that's a better way of saying it. So Frank, I think if you can focus a little bit on who you want to be and then create a framework that can validate the numbers, so that might help give you permission. So good question. That's a big one.
Mm-hmm.
I was laughing because you were asking before, why did you pick this question? This is a pretty long one. It's hard. Okay. The next question is from Jay. Jay says, love your wonderful show. I always have to read that part. And thank you, Jay. I'm glad you do. I see many financial planners and advisors only work with people who already have over 250,000 in assets. I assume it's because it's not worth their time. Another way of saying that it's not profitable. Where can those of us with under 100,000 or 50,000 in assets go for advice for 1 or 2 sessions? I'm of average income and thankfully will have a pension one day, but still need some advice on some withdrawal strategies on my Roth and tax-deferred investments. Who do you know that I can call or where I should go? And then he asked, is this something that the Rock Retirement Club does? Jay, the issue you're facing, and Tanya, I'd be interested in your perspective. There really isn't a lot of good solutions for someone in your situation from an advice perspective. Wouldn't you agree?
Absolutely. Yeah, I think it's an area our industry hasn't sorted out yet.
And I think the sorted out part is, how do you serve someone in your situation profitably from a business perspective to make it viable? And there have been a number of attempts to do so. The good news, I think, Jay, is there are more and more advisors and structures that do. Like I can think of like Garrett Financial Planning Network, and you can Google that and find it, where I believe they work on an hourly basis. Mm-hmm. A lot of people in the XY Planning Network work on hourly or retainer basis. So rather than have asked that, you can actually just pay for an hour and a half session. And the way you take advantage of those, I think, is you want to come with a specific question you're trying to solve for and sort of have everything organized so they don't have to spend that hour trying to organize things just to get to the point. But I think those are 2 good resources. Vanguard has if they're managing your assets, you can pay a little bit extra to actually have access to a certified financial planner. That will probably be more, the word I'm thinking of, generic, but less depth to it, most likely. Mm-hmm. But I know people that use it that like it a lot. I think the Rock Retirement Club is a good place where you're not going to get advice because it's education, but it is a community where it's a safe place to ask questions at a fairly reasonable fee relative to working directly with an advisor. So I do think the resources that I mentioned might be good places to turn. Any thoughts on your end?
XYPN is one I refer people to. I think they've got a lot of good options. And I think there are some advisors that are coming with some unique business models to try to serve some of these areas. They are figuring out a way to be able to deliver it in an efficient manner so it is profitable. So I think XYPN is a good place to start. And I've wrestled with this in my own mind. One of the things that I started to think about was, we were just talking about this, personal trainers, for example. Like if you think about it, not everybody hires a nutritionist if they need to lose weight, or a personal trainer if they need to lose weight, for example. A lot of us will go online, or we'll take a course, or we'll sign up for a blog, or join a community like Rock Retirement Club. We'll do something like that in order to take more of the responsibility, I guess, on ourselves to try to learn what we can in order to make better decisions, because it's just not as accessible. And that's one of the ways I've kind of reconciled that in my mind. I do think there are some good programs that can help with cash flow and budgeting advice. Lutheran Social Services, I don't know if they're national, but I know that they're in the Midwest area. They do a fantastic job helping people sort out things like cash flow and debt. And they do so, I believe, for a small fee, but it's really accessible to everyone. But as far as retirement advice goes, I think you're right on with XYPN and things like your club. You just surround yourself with a community of people who are into this. And I think that you can learn a lot.
Yeah, those are great resources. And I think the danger here, Jay, is in the financial advisor space, the people that are most apt to pursue are going to be people that are selling a product where they get paid something a lot up front, because that's how they get compensated, since you can't pay them outright. You may not see that fee. So I think all the things that I think we've suggested are, one thing nice about these, I think, too, Jay and Tanya, are that you can try one out, whether it's the club or whether it's an hourly financial planner. It's a low cost. So if you meet with a financial planner that charges you by the hour, you're going to get something out of that hour. But if you don't connect with that person, you're not out that too much money, right? It's not a high cost to test it to find the right person or the right service.
Right.
Let's go to our next question. This month, Tanya, the entire month is on inflation and retirement. Inflation's hot right now, literally and figuratively. And Martha has a question on inflation. She says, hey, Roger, with interest rates currently low and the Fed saying that they will probably raise interest rates in the near future, what is the role or usefulness of bond funds in a retirement portfolio? I'm recently retired and my portfolio is 65% total return stock index, 25% bond indexed, and 10% cash. Am I better protected, quote unquote, from rising interest rates with a total return bond fund than individual bonds? What is your feeling about the role of bond funds in general in a retirement portfolio, given that the current projected interest rate environment is not very advantageous? I'm not invested in the bond fund for income, but see it as an investment that would lose less than stocks in a declining market. Is this the traditional recommendation of a 60-40 portfolio given where we're at in interest rate environment? So basically, we're in low interest rate environment. If they raise rates, does it make sense? And they'll likely raise rates. If things are low, naturally, they're going to go back to the mean at some point. Should we even have bond funds or should we have individual bonds? What's the purpose of them? Why even have them?
Well, and I liked that she asked if the traditional recommendation of 60-40 is outdated. Is it outdated given our interest rate environment? I think that's a good question. I think a lot of people are asking that question right now. How do you see bonds right now?
Well, I see them twice on Sundays and every now and then on a Tuesday. Well, I think in retirement, first off, the 60-40 allocation, who knows what the allocation should be. So I think that's more of a mindset of the accumulation mindset. In retirement, I'm a big believer in matching your assets to your liabilities. And your liabilities are mostly the spending that you want to do at a year-by-year basis. So if you want to spend $100,000 3 years from now, well, that's a liability that you have to pay 3 years from now. And so you want to match the money you have to make sure the money's there to pay that liability, which just happens to fund your life. So that's the approach that we think in. I don't like to make predictions about investment returns. And when it comes to rising interest rates, I get it. Interest rates are at zero, right? Pretty much. Almost at zero. But I recall having a discussion, this is like 15, 20 years ago. Interest rates have been falling for back then, 10, 15 years. They're at all-time lows. Let's place a bet that they're going to go up. And this was like 15 years ago. And they've actually gone down and down and down. And then now they basically have stayed down. I guess my point is, yes, they will go up. It could be this year. The Fed does have to unwind their balance sheet and all of that stuff will have to correct itself. The difficult part is knowing the timing of things. And like I said, we thought interest rates were going to go up 15 years ago. They never did. They actually went down. They could simply sit here and grind here for years and years. So making a tactical bet that they're going to go up isn't necessarily a given. And so what I try to do, and then I want to hear your opinion, Tanya, is I like to match liabilities because if you're in retirement, Martha, we don't really care what bonds do. We just care about you being able to pay for the life that you want to lead. We use a pie cake structure, which is a derivative of the bucket structure of having the money to pay your spending and mapping that out for at least the first 5 years. Now, when I get to portfolios longer than 5 years, they're much more equity centric because we know they have a very long-term time frame. If you looked at the entire cake, who knows? It might come out 60-40. But the percentages don't matter. It's the accounting to cover the life that you want to lead. Now, I do think bond funds versus individual bonds, especially for those shorter 5 to 7 years, I am much more of a fan of owning individual securities that have a maturity date. So I know exactly when I'm getting my money back, which is something that a bond fund or even a total return fund doesn't do, right? They just have to grind it out over a very long time. So I'm not a big fan of using any bond funds or portfolios for monies that you think you're going to need within the next 5 years. But when you get to a big, longer term portfolio, I think they're an easy way to use, a good vehicle to use. Okay, there's my little rant, Tanya. Can you be more concise or do you want to rant yourself?
Well, we do use bond funds for our 5-year money. And primarily because over 20 some years in the industry, I think that individual bonds have become, they're definitely more difficult to access for the individual investor. And you can use like some sort of like separately managed account to get those individual bonds. But to me, I never wanted to play investment manager to select which bonds were going to be the ones that do well. Because one of the things that you get with individual bonds, depending on what kind you're buying, if you go buy an individual corporate bond, what if that individual corporate bond is WorldCom? I mean, that's probably outdated now. People might not even remember that. But WorldCom was a big company that went bankrupt many years ago. What if your individual bonds were in WorldCom, for example? Or even like GMAC. Lots of people owned those 15 years ago during the financial crisis. And it was touch and go for sure while the government was bailing them out. So I never wanted to be the decider of which company would be alive 10 or 20 years from now if we were using bonds. Now, if we used 1, 3, 5-year bonds, obviously they're shorter term. It's probably more reliable. Those companies would be there. But I've always elected to use funds because they have managers that are making those decisions and digging into the balance sheets of each of the companies that they have in the underlying funds. But I think Martha's point is well taken that all signs point to bond funds eroding value over time. But I also have this weird thought, like if everybody thinks that the thing is going to happen, does that mean the thing is going to happen? Or is something going to figure itself out? Because for 15 years, as Roger stated, or as you stated, we've all been talking about inflation. Ever since that TARP bailout 15 years ago, we have all been talking about when is inflation going to get here and it's going to kill our bonds. And bonds have been they've done well in the last 15 years as interest rates have continued to come down. So I just don't try to guess on that. We do have our clients have a lot of cash. I think I'm getting a lot of clients asking, well, should we have this cash? Should we have it invested? It's going to lose value. And I just keep reminding people, and I'd remind Martha, just as Roger just did, that cash and the bonds are there to help you live your life. They're not there as like to grow. It's not designed to be your appreciation asset. That's in those 5-year plus equity side of things.
Yeah, you make a really good.
So that's my take.
You make a really good point on the individual bonds. Is that now you have to do all the credit research to make sure it's safe, right? And in reality, we have not built the first 5-year income floor with individual bonds for some time because they're not paying any more. You can get more in a money market. We've ended up having to help clients find CDs, do 3-year fixed annuities, do all these things that assure the money will be there. But you make a really good point on that. All right. Our next question is actually a comment on a previous question that I answered. James wanted clarification on the signature requirements for non-spousal IRA beneficiaries. So this was, I think a few months ago, someone had asked about, it was a little upset actually, Tanya, that hey, I want to name somebody else the beneficiary of my IRA and my spouse has to sign off on it. Why is that? Because it's my money. And the way I explained it was that, well, there are rules that the spouse, and especially has to be the beneficiary to protect the spouse from not getting cut out. And so a lot of times they have to have, and it's dependent state by state on a spouse will have to sign off if they're not the beneficiary, because the idea is, yes, it's your asset, but if you were to pass away, it would go to the spouse. And James says, I was listening to Don't Let Perfect Be the Enemy of Good and heard you say that a spouse needs a notarized signature if changing beneficiaries on an IRA. I researched that for an article and I found that's not the case. The signature is only needed for a 401k per ERISA, which is the regulatory framework for 401k plans. And you're exactly right, James. On a federal level, an IRA doesn't require a spousal signature for a change in beneficiaries away from the spouse, but we do have state law and many, I didn't research this part, but I know I've dealt with it in practical sense, but a lot of states will still require it. So you're right, but there's some nuance to it.
I think the distinction might be whether you're a community property state or not.
That may be, yeah.
Because I'm on the border of Minnesota and Wisconsin. And Minnesota, we do not require that signature, but in my Wisconsin clients, they do. So I think that might be the distinction. Although I'm not, a lawyer, obviously, I cannot provide that type of advice. The other thing, I think the reason on the 401ks, I think it's the spouse, in some cases, they're signing off their eligibility to get an annuity payout.
Potentially, but I know it is under the ERISA framework, and that's the ruling structure. But
okay.
Yeah.
I've seen that before too, where that's part of what the spouse is basically saying. I know that I could get a joint and survivor life annuity, but I'm signing off that it's okay. They're moving this to an IRA. So now I've relinquished my right to that.
That's a good point, even just on a pension option, right?
Yes.
Potentially.
Yeah, same thing. I also think James wanted to know, apparently there was a formal affair that you were attending, and he wanted to know if you went semi-formal or not.
Oh, the wedding. So I went to my niece's wedding in Minnesota, actually. I didn't get to see. Actually, you and I were at the state fair at the same time.
Yes.
And I was whining about having to wear a suit, mainly because I had tried out all my suits and I didn't fit in all my suits. And so I was trying to lobby to be able to wear something other than a suit because I couldn't fit in them all. And so the end of that story was my wife by knife point made me go to the mall with her to buy, I called it fat person clothes, but it wasn't. I was just whiny. And we went to the mall to find clothes that I would fit in. And I've discovered that the elasto band in pants is really comfortable, by the way. And so to buy some dress pants and a coat that I could wear to this wedding. And I did, and I looked fabulous. But I will say, and she was laughing at me because the whole time I was at the mall with her buying these clothes, I was pouting the entire time. I was determined not to enjoy the entire experience, but I ended up having fun at the wedding, and I still don't fit in my suits. So thank you for picking that scab, James. I appreciate it. All right, well, now let's go set a SMART sprint.
On your marks, get set.
And we're off to set a little baby step you can take in the next 7 days to not just rock retirement, but rock life. All right, in the next 7 days, review your inflation assumptions, understand how you got to them, and whether you're comfortable with the methodology that you use, and then just stick with them. Don't overthink it because, and you'll find this out in the next week or two, over time, if inflation continues to rise or falls, as you iterate, you're going to pick that up and make little adjustments along the way. So don't think you can get this right. Just pick some reasonable assumptions and then focus your time on things that you have much more control over. Hey, I want to thank you for the feedback that we've gotten from our Retirement Plan Live series with Joelle. She was awesome. I think there are a lot of things that were teased out, and we got some feedback of what we would like to see, what you would like to see for the next Retirement Plan Live, and we're definitely going to take that into consideration and love being able to chat with you every week, and I hope you have a wonderful one. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.